Good morning, everybody, and happy Friday to everybody. Today is October 20th, 2023, and the top story this morning is no rate hike. At least that's what Jerome Powell, he didn't really tell us. He didn't use those exact words, but that's what Jerome Powell said yesterday at his speech at the New York Economic Club. He basically took any remaining hopes of a November rate hike off the table. And he basically said, we don't need it. Look at what interest rates are doing right now. Look at what the long end of the yield curve has done since the last time we hiked rates. We don't need a rate hike because the bond market has pretty much given us 4 rate hikes ever since we last raised rates on the short end back in July. The 10-year yield has risen over 100 basis points since July. The bond market is hiking itself. The Fed doesn't need to do it. Whether it's bond vigilantes or whether it's term premium, Janet Yellen issuing too many of the things, whatever's driving it, interest rates are rising on their own. The Fed is aware of it. And, well, maybe the market thinks that's good news. I don't really think that's good news, the fact that interest rates are just rising on their own. But the market at least interpreted that as a dovish signal from Powell. And I guess it was dovish. It wasn't necessarily hawkish, but it's also irrelevant because the bond market, again, is raising itself. Other news we had yesterday, the CF in the Middle East just continues to deteriorate. Again, guys, not going to get too much into the humanitarian aspect of things. We're just going to keep it factual here. Yesterday, there were drone attacks on U.S. military installations in Syria and U.S. military installations in Iraq. There was also several missiles were fired from Yemen in a northerly direction. Those missiles were intercepted by a U.S. destroyer, I believe in the Red Sea is where that destroyer was. We don't know what the target of those missiles were, only that they were flying north. The Defense Department said that the destroyer that intercepted the missiles was not the target. It appeared that it could have been Israel, but we just don't know. So you also had riots breaking out at the Israeli embassy in Bahrain. There was some misinformation going around on social media yesterday showing some old video footage of people throwing Molotov cocktails at a building there. That footage was not, well, it was real footage, but it was from years ago. That's not what actually happened yesterday. But there was some unrest outside the Israeli embassy in Bahrain yesterday. So all of this combined just basically suggests if any hopes that this conflict, that this war in Gaza is going to be contained to just the area around Gaza, very little hope of that. This is almost guaranteed to escalate and to spread into other areas, other regions of the Middle East. And that's why oil prices are rising. They rose yesterday. They're up again this morning because this conflict just keeps getting worse. The world just keeps getting worse. And also we got more developments out of China. Evergrande basically canceled their court hearings where they were going to settle their plan to restructure their debt, which means Evergrande's got nothing, that they're going to liquidate the company. Everything's just going to go up for sale. Pretty much worst case scenario for Evergrande. Country Garden still has not said a word about defaulting on their bonds. And again, I guess if you just never use the word default, then you never actually defaulted. That's how that works in the bond market in China, apparently. And the Bank of Japan was warning banks this morning, saying, hey, guys, you better position yourselves for higher interest rates. I'm not saying interest rates are going higher right away, but you better start positioning yourselves. You don't want to have a Silicon Valley Bank situation. Silicon Valley Bank famously took out a massive position in long-duration U.S. Treasuries, but did not appropriately hedge the risks of rising interest rates. I guess they figured, hey, Jerome Powell said in the summary of economic projections or the dot plot at the Fed, they told us they weren't even going to consider starting to raise rates until 2024. Whoops, 2022 and 2023 happened, so that didn't work out so well. Silicon Valley Bank was caught off sides. They took huge losses on their bonds, and as soon as their depositors got wind of that, there was a run on that bank, and we all know what happened in March. So the central bank in Japan, the BOJ, this morning is saying, hey, Japanese banks, you guys need to hedge for rising interest rates. We're going to eventually let these rates rise. They're trying to rise on their own. We're holding them down as they're rising slowly. You guys need to position yourselves for higher rates. We don't want another SIVB happening in Japan. And with that, let's shrink my big melon of a head And while we're doing that, guys, won't you please hit that like button and subscribe to this channel? Have your coffee with the Melonheads every morning. We do this every day. And before we get into this one, I just have to thank, I can't remember the name of the person who commented yesterday, but somebody pointed out that the Fear Greed Index had not been updating on CNN Business. That has been resolved. I don't know what it was, but the Fear Greed Index was stuck at 35 for 3 days, and I didn't even realize that it hadn't been updating. But I just checked right down here in the fine print, last updated October 20th. So the Fear Greed Index is now updating. I apologize for not catching that one. The thing was stuck at 35 for 3 days, and I just didn't catch that it wasn't updating. This morning it is. It is lower at 29, still in fear territory, but tipping towards extreme fear. The S&P 500 is currently down 12 points this morning, or 0.29% ahead of the opening bell. The Dow is down 90 points, about 0.25%. And the NASDAQ is leading the way lower, 54 points to the downside, or 0.36% lower ahead of the opening bell. So stocks are red across the board this morning. The U.S. dollar is essentially unchanged. It's down 1 basis point at 106.24. Not a lot of movement in the dollar the last couple of days. Bonds, however, have been a little unusual this morning. They were down bond yields were down significantly. Bond yields being down means bond prices were higher. And they're in negative territory again here. But it's been unusual this morning. Bonds were surging right before we went live. Now they're back down a little bit. The 30-year Treasury is up 1.4 basis points this morning at 5.11. That is the only bond yield that's higher, with the exception of the 1 month. I wouldn't worry about that. The 10-year is down 3 basis points right now, yielding 4.958. That's after yesterday it touched 5% for the first time since, I don't know, when was the last time the 10-year was at 5%? A long time ago, guys, a long time ago. Chances are before some of you were even born. Interest rates on the long end just keep rising. They're taking a break today. We kind of expected that they would take a break today because of the situation, the psychological aspect of that 500, having that 5% barrier there. I think a lot of people probably program the algorithms to buy when we get there. So it's going to take a while, I think, to break that. Or we could see it move higher today. Who knows? This bond market is not exactly following historical norms at the moment. The 2-year Treasury is at 5.127 this morning. That is down 4.5 basis points. And the 1 month is yielding 5.417, up 1 point. Looking over at the commodities board, talking about things that are not doing what historically they have been supposed to do. Gold up another $9 today, 0.46% higher. Gold is pushing $2,000 here. December gold futures at $19.8950. Guys, as the interest rates have been rising, gold has been rising along with it. It's not supposed to work that way. For whatever reason, people are not looking to bonds as the safe haven asset that they have once considered it to be, but gold is getting the benefit of all of that. So it's been very unusual to watch gold rising along with interest rates, but there it is. And silver is getting in on the action too. December silver futures at $23.24 this morning, up 21 cents, or 0.92% up. We've got platinum is down 1/3 of 1%. January platinum futures at $900.95. December palladium futures at $11.04. That's down about 1.25% this morning. And West Texas intermediate December futures at $89.23. That's up another 86 cents this morning, or about 1% higher. That's after it was up a couple of bucks yesterday. Let's talk about oil. We got this one in Barron's this morning. Oil and gold rise after U.S. intercepts missiles from Yemen as Mideast tensions rise. U.S. warship intercepted missiles coming from Yemen on Thursday, adding to tensions in the Middle East after Hamas attacked Israel almost 2 weeks ago. The fear for investors is that a wider war could disrupt supplies of oil, since neighboring Iran and Saudi Arabia are major global producers. Traders may also flock to safe haven assets such as gold as protection as an uncertainty. Probably one reason why gold has been rising. Following the missile interceptions in Yemen, gold and oil rose. It came a day after President Biden returned from Israel, where he reaffirmed U.S. support for the country and argued the rockets that landed near a hospital in Gaza earlier in the week probably weren't fired by Israel. So it was really that missile attack from Yemen. We don't know what they were shooting at, just that the missiles were heading north from Yemen, which there's a lot to the north of Yemen. It could have been anything. Those missiles intercepted by a U.S. destroyer, that sent oil higher, but you also had drone attacks against a U.S. base in Syria. Right before President Biden went live in his address yesterday, there was another drone attack against a U.S. base in Iraq. You had the unrest in front of the Israeli embassy in Bahrain. There are missiles being fired across the Lebanese borders, and the Israelis are returning fire against Hezbollah there. This conflict, this war is not going to be just limited to Gaza, guys. That's the writing on the wall here, and the oil market is sniffing that out. Now, if we do see disruption in oil supplies caused by the war, or geopolitically, if, say Saudi Arabia or Iran just decide they're not going to sell oil to us anymore because of what's going on in Gaza, or if for some reason, say, we put sanctions back on Iran because they're financing terrorists, one of the things that might offset some of that oil disruption is this story from Venezuela. Venezuela's oil can fill some of the market shortfalls. This just came out yesterday in Barron's. A deal struck between Venezuela and the U.S. to allow more Venezuelan oil exports in return for political reform will boost global oil supplies and could make a small dent in prices. Emphasis on a small dent. While Venezuela's oil production remains relatively low, it could be enough to nudge the market back into balance after several months of undersupply. The Biden administration agreed Wednesday to ease sanctions that had been placed on Venezuelan oil over the past 4 years in return for a pledge by the government to set up free elections next year. Venezuela today produces about 800,000 barrels of oil a day, down from a peak of more than 3 million barrels. Global output is 101 million barrels. With the sanctions on pause, Venezuela could increase production by about 200,000 barrels a day, Rystad Energy predicts. The Energy Information Administration predicted earlier this month that the oil market will be undersupplied by 200,000 barrels through the first quarter of 2024, raising the possibility that Venezuela could plug that gap. So 200,000 barrels a day from Venezuela, not a huge amount of additional oil supply, but it certainly helps. Now, in context, Iran is selling somewhere around 4 million barrels of oil a day. So, if the sanctions go back on Iran, or if there's anything resembling an embargo like we had in the 1970s, this 200,000 barrels from Venezuela not going to be anywhere near enough to make a dent in that. But in the meantime, it helps. This will alleviate some of the pressure on oil prices. And talking about that pressure on oil prices, this is the long-term chart of oil here. It's looking pretty good. We had that golden cross. That was back in August. We've got the 50-day moving average right here. We dipped below that twice, failed that, retested a few times. It really looks like oil is just going to keep surfing that 50-day moving average higher right now. I think $100 oil by the end of the year is probably a conservative estimate at this point, especially if the situation in the Middle East keeps doing what it's doing. Guys, oil prices were set to rise before that even happened. Now, we did have this big drop here. That was in late or early October, late September. That was on a couple of very unusual inventory reads in the U.S., where we had a big surge in gasoline inventory, and then the following week there was a big surge in crude inventory. That had spurred fears of demand destruction. That story has fallen by the wayside, as fears of supply disruption are now much greater than that. But that's also something to keep in mind, guys. A slowdown in the global economy will destroy demand also. If everybody's going to war, though, we're going to be burning more oil. War takes a lot of energy. That's just the way it is. Now, let's talk a little bit about what the Fed said yesterday. Bond yields are surging, and that could help keep the Fed on hold. Jerome Powell made this speech at the New York Economic Club. That was after the idiots with the pink hair set up their banners and protested climate change and yada, yada. Nobody's allowed to drive to work in the morning because my father didn't pay enough attention to me as a child, and so now I protest climate issues. That disrupted Powell's speech. They scurried him off the stage with security while they pushed those people out of there. Then Powell came out and made his remarks. Another interest rate hike looks to be off the table at the Federal Reserve's November policy meeting, and maybe at the December meeting too. A leading reason: sharply higher bond yields. Fed Chair Jerome Powell laid the groundwork on Thursday in a speech to the Economic Club of New York for the central bank to hold interest rates steady at its October 31st and November 1st meeting. In prepared remarks, Powell highlighted that the economy is already moving towards price stability and that lags in monetary policy and rising geopolitical uncertainty are forcing the Fed to proceed carefully. Now, this is important because the Fed, they were doing their 75 basis point hikes last year. Then the taper talk came in. They started doing the 50. Everybody started talking about pivot. Then they started doing the 25. They said, all right, the Fed's going to be lowering rates any day now. Then they went from the 25s to doing a 25 every other meeting. So they kind of made it. They went from 25 to 12 and a half if you average it out. Well, they would be on pace to hike again in November because they skipped the last meeting after hiking in July. But what they're saying here now is now we're going to skip another meeting. This would be the first double skip. So this is increasing the likelihoods of the Fed pause, that they're not going to hike again. This would be the first time they went 2 meetings without a hike since this whole cycle started. The Fed is in no hurry to tighten monetary policy further. A November rate hike can safely be priced out, writes EY chief economist Gregory Dacko. The markets agreed the odds that the Fed will keep the target rate at 5.25 to 5.5 were 99% following Powell's remarks. Now, here is the odds of a rate hike in November. They are currently 0. No chance of a rate hike in November, according to CME interest rate futures. We have got a 98.4% likelihood that the Fed does not raise rates. And you've actually got a 1.6% chance here that the Fed lowers. That's new. That's saying there's a 1.6% chance that something really bad happens in the next 11 days. So that kind of came out of nowhere, that 1.6% likelihood of a hike, of a cut in November. Again, that's 1.6%. It's not going to happen, but that's interesting. But if you look at the December odds here, there's only a 20% likelihood of a hike in December. And then in January, you've got a 29% likelihood of a hike in January. So the market is starting to price in that the Fed, they're just about done here. Now, how long they stay here, that's a whole different story entirely. Now, the reason why I want to talk about why the Fed is likely done here, let's talk about the last time the Fed hiked was at their July meeting on July 26th, right? So here's July 26th right here, all right? So the interest rate on the 10-year Treasury was 3.87% at the close on July 26th, the last time they hiked. Right now, it's about 4.95%. It was almost 5% yesterday, all right? So you're talking 110 basis points since the last interest rate hike has risen in the 10-year yield. 110 basis points. We've had 4 rate hikes on the long end of the yield curve since their last rate hike on the short end. So that's why they're saying the Fed doesn't need to hike here. The market is hiking itself. And guys, I just want to add that in the 10-year yield, it's not supposed to rise that fast. And zoom in way out on this chart. Look at what this thing has done since the first rate hike. 500 basis points almost, or nearly 500 basis points of an increase in interest rates since they started down this track. So something's going to break here, guys. You can't have a big move like that without something breaking. We've already had 3 somethings broke. Silicon Valley, Signature, and First Republic. Those were all things breaking, and interest rates are only higher than they were back when that happened. So we could be right around the corner from something else. And let's shift gears a little bit. Going across the pond, Country Garden default is all but official, and restructuring looms. Yes, it is. It's official. They did. You can't just silence your way out of a default. That's not how that works. I mean, try it. Stop paying your bills and see what happens. Trust me, it doesn't matter if you don't say anything about it. They're going to come after you. Developer is yet to pay their dollar interest after an end of a grace period. The firm says it hopes to seek a holistic solution to the debt problems. Does anybody know what a holistic solution to the debt problems is? Is that like the right blends of herbs and spices and positive vibes and we can solve this problem, bro? Is that what a holistic solution is to a $150 billion pile of debt? Gotta love these talking points coming out of there. It's likely just a formality before Country Garden Holdings' missed dollar bond interest payment is declared a default as creditor focus shifts to a potential debt restructuring for the distressed Chinese developer. China's former top builder hasn't offered fresh comments after saying Wednesday it doesn't expect to be able to meet all offshore payment obligations on time. It cited China's home market weakness and its own subdued sales as reasons, according to a statement to Bloomberg News at the time, adding that it hopes to seek a holistic solution to debt problems. And I think Evergrande could use one of their holistic solutions also, because this one just hit the tape. China Evergrande cancels court hearings for their debt plan as the developer and creditors seek to revise their $20 billion restructuring deal. The hearing was scheduled for the 16th and 17th. They were canceled. They would have put the final seal of approval on this deal. This deal is dead. Why is this debt restructuring deal dead? Well, the decision to cancel the approval hearings followed a breakdown this month in its debt agreements that forced both parties to backtrack from the home stretch. Evergrande is seeking to reassess terms, citing weaker than expected home sales. The sudden arrest of its founder and chairman, Hui Kai-yan, by mainland Chinese authorities has also complicated the matter. Basically, guys, Evergrande's going to have to liquidate. They had this deal they were working out. They were almost done. They were going to restructure everything. But then the home sales got even worse, which means Evergrande didn't even have enough money for this restructuring deal. The writing is on the wall here. They're going to have to just liquidate the company and fire sale everything. And that is going to make the situation in the Chinese property market even worse, because when they put all those buildings up for sale, they're very quickly going to realize there are no buyers. And remember, real estate is all about comps. If the prices fall for the building, then the building next to it, its price is going to fall, and the one next to that, and so on. So this is the contagion risk. It's still there. Even Evergrande, that story, I mean, they've been in default for over a year and a half now, and this mess is still going on. Country Garden is repeating the same playbook, just in slow motion. We're a long way from any resolution in the Chinese property crisis, guys. And also going on across the pond in Japan, Bank of Japan's Ueda says need for risk management of rates is increasing. This is another one it's important to keep an eye on. Bank of Japan Governor Kazuo Ueda urged Japanese credit unions to undertake proper management of interest rate risks, citing the banking crisis that shook the U.S. financial system earlier this year, as well as high uncertainties related to the domestic economy. The importance of risk management for interest rates is rising even more given extremely high uncertainties over the economy and inflation in our country, Ueda said in a speech at the National Credit Union Conference in Tokyo. I want you to continue with appropriate risk management. Now, guys, this risk management, this is huge. Do you remember the bond crisis in the UK from October when the UK's pension system almost blew up and the Bank of England had to print money and start buying up bonds to try to save their pension system? And then a few months later, Silicon Valley Bank blew up. That was all because these institutions had made bets on low interest rates and they didn't properly hedge. They didn't make side bets where just in case interest rates rise, they had some other position in place that would compensate for losses in their long bonds. Well, the Bank of Japan is saying, yo, Japanese banks, you better hedge your interest rate risk because interest rates are going higher. That's what Ueda is saying here. We don't want to have a UK-like pension crisis. We don't want to have a Silicon Valley Bank thing going on in Japan. Now, why is he saying this? Take a look at what the Japanese 10-year JGB or Japanese government bond has done in the last few weeks. This is going back to about May. Now, right here in July, this is when the Bank of Japan announced that change to their yield curve control policy, when they said, okay, we're going to go from holding our rates below 0.5%. Instead, we're going to hold our rates somewhere between 1% and 0%. And the market interpreted that as saying interest rates are going to rise to 1%. And ever since then, we have seen Japanese government bonds slowly working their way higher. And here they are right now at 0.83% yield on the 10-year JGB. Now, guys, this is up again today. That's after yesterday we had that unscheduled bond buying operation from the Bank of Japan. That's when the Bank of Japan says, all right, we're going to print money, or we're going to spend some of our money and we're going to buy Japanese government bonds to bid up their prices and force down the interest rates. Well, the Bank of Japan did that yesterday, and interest rates are saying, I don't care, you guys, I'm going higher. They're still moving higher. 0.839 this morning is down about a fraction of a point from yesterday. But these rates are rising. The Bank of Japan is saying, banks, get ready for these rates rising. We're holding the rates lower. They're rising anyway. The second we stop holding them lower, they're going to rise a lot. And they're just trying to warn the banks. They're saying, guys, get out in front of this because this is coming. Inflation is rising in Japan. Oil prices are rising again. The Bank of Japan is having to work overtime to keep these bond yields suppressed. Sooner or later, Japanese interest rates are going to fall in line with the rest of the world, which is a whole heck of a lot higher than 0.84% right now. And he's warning the banks, you guys better position accordingly. And I just want to say thank you this morning to Mr. Kevin DeBella. Thank you, Kevin. Says, when all else fails, they take you to war. Gerald Salenti. You know, okay, I guess it's tinfoil hat time, Kevin, because, man, you know, who could have predicted that this economic crisis or non-crisis, whatever, would have led to another global war? I mean, geez, it's not like we've been saying that for the better part of 2 years, and yet here we are. You know, a lot of that speech yesterday that I watched President Prune Juice give, he was talking about how, all these munitions and everything, they're going to be made in U.S. factories by American workers. Oh, great. The stimmies that go boom. Is that what we're talking about now? Yeah, Gerald Celente was right. When all else fails, they take you to war. Are we going to keep escalating in hopes of saving the bond market? No, Kevin, I don't think we're going to do that. I think we'll keep escalating? Yes, but I don't think it will save the bond market. I think we're escalating right now to save GDP, to save the economy at the expense of the bond market. Because right now the bond market is crashing. This is the worst bond market in history right now. I mean, if you put all of your money into U.S. Treasuries in 2021, you are like wiped out right now. You've lost 50, 60% of your money. That's what killed Silicon Valley Bank. That's what killed the UK's pension system. It wasn't U.S. Treasuries. It was UK gilts, but same thing. What we're doing right now is the government is debt spending money to keep gross domestic product up, to keep the economy artificially high. But that's at the expense of the bond market because they're having to issue so many bonds in order to borrow the money to spend into the economy. And the interest rates are rising because the bond market is saying, we don't have that much money to give you. We don't have that much liquidity left because the Fed is no longer giving us money. The Fed is actually destroying money. Foreign governments are no longer buying our treasuries. So there's just not enough bond markets. So actually what they're doing with the war, Kevin, is they are sacrificing the bond market. They're playing a game of chicken with the Fed. That's what the Treasury is doing, issuing all these bonds, causing interest rates to rise, sapping liquidity. They're basically saying, hey, Fed, sooner or later, you're going to have to bail us out along with the banks. That's what Janet Yellen is saying our banks are strong and resilient and well-capitalized. And, oh, I know the U.S. government, like our banks, is also too big to fail. And Jerome Powell is going to have to print money to bail me out, too, even though I said a few years ago, no more economic crisis in our lifetimes. That's Janet Yellen. That's basically what she's saying right now. So thank you, Kevin, for the super chat, support of the channel. I appreciate that very much. And thank you, Keenan. Sorry, Keenan. I've said your name 100 times. Couldn't get it out this morning. Keenan Haywood says, Friday trivia, which happens first? The reverse repo balance reaches 500 billion or the 10 to 2 year uninverts? Feel free to save for the afternoon show. Okay. I'm going to have to think about that one. The 10 to 2 uninverts or 500 bill. I'm going to go with the 10 to 2 uninverts, but you know, we'll do a more nuanced look on that on the afternoon show today, Kevin. That's a good idea and a great plug for the Friday afternoon live stream at 3:15 p.m. Eastern time. We do that every week, our long form weekly wrap up. But yeah, my gut reaction says the 10-2. That thing is uninverting rapidly right now, Keenan. Thank you, sir, for the super chat, the support of the channel, and thank you, Dan Hedin. Jack, is gold decoupling from bonds or just the war? My gut tells me gold is decoupling here. And now this is not, how do I say this? I want to temper my own enthusiasm a little bit here. The gold decoupling, gold has not been crashing with the higher interest rates like it should. It's only been going on for like a month. All right. Gold, in my opinion, gold should be a lot lower based on what interest rates have done. Now, I'm still long gold. I still buy gold on a regular basis and silver on a regular basis, right? I like the shiny, but just the relationship between interest rates and gold price, gold should be heading lower, and it's not. So gold has decoupled recently from the bond market. Now, will that maintain or will it snap back violently in one direction or the other? I don't know. We could see a violent snapback here, right? We could see yields plunge down all of a sudden to fall in line with what the gold price has done, or we could see the price of gold crash to fall in line with what yields have done. Either of those things could happen here. It hasn't been that long of a period of time. So, we're talking about a multi-decade interrelationship between gold and bonds that just hasn't held true for the last couple of weeks. So I don't want to be too alarmist here. But that being said, gold and rates are not doing what they're supposed to here. So that's worth paying attention to. And it's worth digging into it to try to figure out what has changed in the world that might explain this interrelationship falling apart right now. And if you ask me, that is the increasing rate of deterioration of the U.S. fiscal policy. The fact that we're just draining the bond market, draining the reverse repo at a ridiculous clip. It's also saying that maybe the bond market is betting that inflation is going to rise again, that maybe they're saying, hey, your short date treasuries, they're fine. But if I'm going to invest something 10, 20, 30 years, I want a heck of a lot more than 4.5%, 5% to put my money out that far, because I believe inflation in the next 30 years is going to outpace that. So you still have negative real yields on the long end of the curve. Maybe that's why gold and silver are not behaving in accordance with yields. It's worth looking into. I don't have all the answers to that one, Dan, but that's a big one. All right, guys, I ran a little long today. Thank you, Dan. Thank you, Keenan. And thank you, Kevin. I appreciate the super chats, guys. Thank you also to all my Patreon supporters for everything you guys do for the channel. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Until next time, live small and dream big.